What if everything you believed about your savings was wrong? What if the money you carefully deposited, the accounts you rely on, the investments you trust, were quietly losing value faster than you realized? Imagine waking up one day to find that the system you counted on to secure your future was rigged not against Wall Street. It's not against banks, but against ordinary people like you. In 2025, your savings might not be what you think they are. And the truth behind this quiet erosion is far more shocking than most want you to know. Welcome to Dollaroid, your hub for uncovering the hidden truths behind money, savings, and the global financial system. If you've ever wondered what really happens to your money and how the system affects your wealth, you're in the right place. Let us dive into the story of your savings in 2025 and why what you think is safe might not be what it seems. To understand why, we have to start with the history of money itself. For centuries, saving meant something real. Gold coins, silver, tangible assets. Even in the early 20th century, deposits in banks were backed by physical reserves. People knew that if they stashed money safely, its value would be preserved. But that era is long gone. The shift began with the rise of modern central banking and fiat currency. Once governments realized they could print money at will, they could manipulate economies, interest rates, and the very value of money itself. What seemed like stability bank deposits, savings accounts, bonds was slowly transformed into a tool to funnel wealth in specific directions. And the twist: ordinary savers were rarely on the winning side. Fractional reserve banking became the engine of this transformation. Banks discovered they could lend multiple times what they actually held, creating money out of thin air. This expansion of credit fueled economic growth, but it also sowed the seeds of instability. When too much money was created without real backing, inflation would quietly erode the purchasing power of your savings, often without immediate notice. By the late 20th century, central banks had learned how to manage crises with a combination of interest rate manipulation, quantitative easing, and emergency bailouts. These tools kept economies afloat, but at a cost. Every time a government injects liquidity or reduces interest rates, savers effectively pay a hidden tax. The slow devaluation of their money. Your hard-earned deposits might look safe on paper, but the real value, the things you can buy with that money, shrinks every year. Every system has a breaking point. The 1970s brought high inflation and stagnant wages, a period famously called stagflation. The 2008 financial crisis wiped out trillions. In savings and pensions worldwide, governments responded with emergency measures, zero or near zero interest rates. Unprecedented money printing, but these fixes only postponed the inevitable consequences for ordinary savers. In fact, every so-called solution seems to carry the same pattern. The government prints money to stabilize the system, banks profit from lending and speculation, and the public sees little to no real benefit. Inflation quietly eats away at deposits, pensions, and bonds. By the time citizens notice, the system has moved on, and a new cycle begins. Now, let's connect this to 2025. Current data paints a stark picture. Global inflation is stubborn, with some countries experiencing double-digit increases in essential goods. Savings account interest rates are near historic lows, often failing to keep up with inflation. Meanwhile, real estate and stock markets are inflated beyond historical norms, creating an illusion of wealth for those who are invested but leaving traditional savers behind. Even digital banking and fintech, often hailed as revolutionary, do little to change this fundamental reality. The underlying systems, fiat currency, central banking, fractional reserve, lending remain the same. Your money in an app or online account may be convenient, but its real value is still subject to the same invisible erosion. To understand why this happens, consider this cause and effect chain. Central banks manipulate interest rates, gives low interest, discourages saving, gives. Governments inject liquidity, gives asset prices rise, gives everyday money, loses purchasing power. Each step is predictable, yet most savers are unaware, trapped by the illusion that their balances are safe. The fallout is already visible. Retirement accounts are underperforming relative to living costs. Middle-class households struggle to maintain purchasing power, even with steady incomes. Governments encourage spending and debt as a form of economic stimulus, but the hidden cost is the slow destruction of real savings. The richest individuals and financial institutions, by contrast, often profit from these cycles, exploiting rising asset prices while ordinary savers see their wealth quietly stagnate or decline. Attempts to fix these problems have been largely symbolic. Some advocate for gold, cryptocurrencies, or other alternative assets, but adoption remains limited, and volatility creates risk. Government-mandated inflation targets and stimulus programs often prioritize economic growth over preserving individual wealth. In short, structural solutions that truly protect ordinary savings are rare. So what can we learn from this? First, your savings are not immune to systemic forces. Even accounts that appear safe are subject to inflation, currency, devaluation, and central banking policies. Second, the system favors asset holders over cash holders. Investments in real estate, stocks, or commodities often appreciate faster than money in the bank. Third, awareness and proactive strategy are essential. Understanding how money, interest rates, and government policy interact is the first step toward preserving real value. The warning is clear. 2025 may seem like a normal year, but for savers relying solely on traditional methods, real purchasing power is quietly shrinking. The war is not over, and it is not always visible. Those who fail to understand the mechanics of money risk losing far more than they imagine. The open-ended thought is this: if traditional savings can no longer guarantee security, what does real financial stability look like? Is it diversification, alternative assets, or a complete rethink of how we measure wealth? The answer is not simple, but ignoring the problem guarantees one outcome: the slow erosion of what you thought was safe. If you found this analysis eye-opening, subscribe to Dollaroid and turn on notifications. Understanding the truth about your savings is not just about money, it's about protecting your future, making informed decisions, and staying one step ahead in a system designed to favor those who understand it.